Hello, everyone. My name is Matt Murphy. I'm a certified financial planner with the Certified Financial Group in Altamont Springs, Florida. And want to thank everybody for tuning in today for what I feel to believe is a very, very important topic, which is investing in a market downturn. We've had a lot of client conversations over the last several months on this subject, as you might imagine. And what I've gathered is that folks kind of have two main questions. Number one is what's different about this time when the market's going down? In other words, is this following historical patterns? Is it following historical trends? Is there something different about what's happening in the market today? So we're going to address that question. And then secondly, what should I do about it? How do I respond to what's going on in the market right now? So again, the title of today's presentation is Investing in a Market Downturn, 8 Principles and 9 Opportunities to Consider. So first part, we'll be talking about the 8 principles, history of the market, how comparing today's market activity sort of stacks up against what's happened in the past and making some sense out of that. And then the second piece, the 9 opportunities. What specifically can you do to capitalize on what's going on in the markets right now? So let's jump right in to the 8 principles. And I'm going to list them out here first of all, and we'll dive a little bit deeper into each one of them as we go. The first being it pays to own stocks. The second, pullbacks and even corrections are to be expected. That's part and parcel with being invested in the market. Number 3, keep a long-term view to protect your long-term goals. I get a lot of clients over the years that kind of chuckle at this type of thing. They say, Matt, I don't have long-term anymore. I'm in my 60s or my 70s or my 80s. And I understand that, and we're going to talk a little bit more specifically about what it is that we mean when we say long-term. And how to tailor the way that you see and react to what's going on in the market based upon what your time horizon is. Number 4, higher rates do not necessarily mean that stocks always will go down or the end of equity gains there. Show you some good historical data on that. Number 5, volatility often comes with rising rates in midterm elections. That's pretty much always the case, and we have both of those. We have rates going up, and we have midterm elections. Going to show you some good data on that. Number 6, non-recession bear markets are typically more shallow and rare. There's been a lot of debate out there as to whether we're in a recession right now or we're not in a recession, or if we're going to enter into a recession. The market tends historically to behave differently depending upon whether the bear market or the downturn in the market is accompanied by a recession or not. So we'll unpack some of that data as well and show you the implications of that. And then number 7, market timers miss out. We're going to give you some really great statistics about trying to time the market. And the old adage says what's more important is time in the market rather than timing the market. I'm going to prove that to you. And then finally, the proverbial make lemonade when you have lemons. So in other words, how do we capitalize upon, as I said before, the downturn in the market and make some lemonade out of the lemons that the market has given to us. So how do we make something good out of this rather than just kind of, being fearful and not reacting at all? Okay, so let's jump into the first principle, which is that stocks have gained over the long term. Spoiler alert here. This is a really great slide because it gives you an opportunity to kind of zoom out, if you will, and look at all of the various things over the years, over the decades that have occurred in the market. In this case, we're just going back to 2009, but you can see everything that's happened then. Obviously, that was immediately following the financial crisis. Then you had the Eurozone crisis. The fiscal cliff. It seems like ages ago that was a thing, but that was a big deal, huge concern. Brexit, 2016 elections, and so on and so forth. And then, of course, COVID here 2 years ago. And yet what you notice is that the general trend over the long term is up. And that's because, really history has shown us that over the long term, there simply is no better way. There's no alternative really to providing long-term wealth growing ability than stocks, than equities. And so this chart, basically just shows, in spite of all of the short-term occurrences that happen, the market has a really good habit over time of going up. This is a really neat chart here, and basically just shows that almost every year going back to 1926, or I shouldn't say almost every year, but most years, it has paid to own stocks, most individual calendar years. In fact, in only 11 times going back to 1926, if you'll notice there, has the market been down more than 10%. In fact, 75% of the time, the market's been up over that, roughly 100-year time frame. And in fact, it's gone up 20% or more in almost 38% of the years. So the point there is that, oftentimes when we're in the midst of a down market like we are right now, it feels acute, it feels painful, it feels like this has never happened before, and yet it has happened before. However, the odds are in our favor that after that has happened, after the market's gone down, that we have a really, really good chance, statistically speaking, that good years will follow that. And that's really what kind of the moral of the story here is. Even in good markets, drawdowns or pullbacks, if you will, are natural and almost always happen. So, historically, there's been about 3 to 5 drawdowns of about 5% through the course of a year. So, again, you can kind of think of almost, riding in an airplane and you have a really, really smooth flight and you get a little bit of bump or a little bit of turbulence. Doesn't mean that the plane's going to crash. In fact, that's normal and that's natural. The key there is just to stay the course. And this chart shows that the number of 5% drawdowns that were experienced all the way back to 1980. So you can see even in good years for the market, there's almost always multiple pullbacks of 5% or more. Totally natural, and you just want to know that going in so that you don't make a rash decision to sell out of the market. So building off the last slide, even the best years, the absolute best returning years for the stock market always have at least one intra-year decline. And of course, an intra-year decline meaning, you could have a year in the market where it's positive for the entire calendar year, but during that year, the market goes down. So the two most really pronounced and best examples of this intra-year decline, of course, would be back in 2009 when the market ended up for the year 23%, and yet during the year it experienced a 28% intra-year decline. Even a more sharp example of that would be, of course, in 2020, where the market ended the year, the S&P 500 was up 16%, and yet we had a 34% intra-year decline. And in fact, if you recall, that happened really in the span of about a month, where that 34% from peak to trough in the market. So very, very quick, very acute downturn in the market. However, the year ended up positive. So again, the point there being that much like we're seeing here recently, just because the market is down at one particular point in the year does not always necessarily mean that it will remain down. And probably more importantly, we'll get into this a little bit more later on in the presentation, more importantly, it certainly should not be a signal for you to sell out at that point, because oftentimes that's right at the time at which the market tends to recover and rebound. So keeping a longer term view is, and really more specifically your time horizon, to me this is probably one of the most important aspects or components of what we're going to talk about today, because your time horizon is so very important. And what you'll see on the chart there is how often the frequency of the S&P 500, the broader stock market, how often it goes down in a given time period. So in this case, 1 year, 3 years, 5 years, 10 years, 15, 20 years, how often that occurs that the market would be down. So for example, if you look at the 1 year, what it shows is 80% of the time in any given 1 year time frame, the market is positive. So 20%, obviously, 20% of the time, the market would be negative. All the way up to 20 years, and even 15 years for that matter, what you notice is that there are no 15 or 20-year time periods where the stock market has been negative. So the implication of that is the longer, and it's going to sound very common sense, but the longer your time horizon, the more you should be invested in equities. The shorter your time horizon, the less you should be invested in equities. Again, sounds pretty common sense here. However, this is where planning comes into play. Okay, so obviously you can see there's then 3 years, 5 years, 10 years in between all of those time frames. The key is to figure out what exactly your time horizon is. In other words, if I've got a pot of money saved up, my nest egg, when am I going to need to actually start drawing from that nest egg, and how much am I going to need to start taking out? And that, combined with then your risk tolerance and the rest of your financial situation and so forth, ultimately will be the determinant of how much you should have in stocks and what your overall exposure to the market should be. But again, really two implications from this. Number one, even in any given 1 year time period, the odds are stacked well in your favor to the tune of 80% that the market will be positive. And over a 15 or 20 year time frame, if you've got that much time on your side and you're not investing in the market, you are most certainly leaving money out on the table. Okay, so again, the longer your time horizon, the greater opportunity you have to increase your returns. So for example, over a 5-year rolling period, as you can see there, the 50-50 stock to bond portfolio could return anywhere from 1 to 21% per year. So obviously stocks and bonds can be much more volatile during a short time period, such as 12 months, and you can see that as illustrated there. Where the worst 1 year return for the market since 1950 was down 39%. The best 1 year was up 47%. And so for bonds, the best 1 year over that same time period, up 43%, down 8%. By mixing those two together, the stocks and the bonds, we kind of narrow the range of outcomes. Yes, you're lowering it on the upside, so a little bit less return potential. But more importantly, to most folks that are either nearing or in retirement, we're also narrowing the downside potential significantly here. And so, again, as I mentioned before, the trick to this, or the key to this, is planning, to really understand exactly what your time horizon is. When am I going to need this money? How long am I going to need it for? And how much am I going to need? That is a primary determinant, should be a primary determinant of how your money is invested and what the different types of buckets are that you put your money into and how much. Okay, so as we mentioned before, interest rates don't always mean that the stock market goes down. So in fact, the Fed's starting to raise rates here in March of 2022, March 16th of 2022. What we found is that on average, both the average and the median, about 4 years later after the initiation of rate hikes is when the bull market peaks. And during that time period, on average, the market's gone up about 84%, and the median market return has been just under 60% over that same time period. So let's look at the next slide, and we'll put a little more specifics to this. So what we can see here is really the last 5 rate hike cycles that the Fed is engaged in. And in all but one, less than a year out, the market was higher than it was when the Fed started raising rates. And the only exception to that, as you can see, February 4th of 1994, the market was basically flat. It was down marginally over that time period. So what you will notice, however, on the chart is on the left-hand side, it's most of those scraggly lines are below the 0%. In other words, they're negative for a while before they turn positive, almost up to maybe 100 days in most cases. And that kind of stands to reason, because when the Fed starts to raise interest rates, investors are trying to make sense of that. What does this mean? What's the implication to my portfolio? What does this hold for the future of the bond market and the stock market and the economy and everything else? So normally investors take a little time to sort that out. But as we can see here, normally after that happens, it ends up being actually a net positive for the market. Presidential cycles and election cycles, there's a lot of study that's done into the behavior of the market based upon where we are in the election cycle. And in this case, the midterm year, or the second presidential year, typically historically is the worst year for the market. It has the most average intra-year drawdown and the lowest average yearly return. The good news is typically what's considered the pre-election year, which is the year after the midterm, tends to have not only the best average rate of return by a long shot, 18.5% historically, but also has the lowest average drawdown during the year. Now, I just want to say that this information is not intended to try and time the market. It doesn't always work perfectly like this. So I don't want anybody to take that information and think that, next election cycle or next year, since we'll be in a pre-election year or, after the midterm, that this is time to just load up on stocks. It may be, it may not be. But I just wanted to illustrate to you that it's not unusual that the midterm, since we've experienced quite a bit of market turmoil in 2022, it's not unusual for that to be the case in a midterm year, nor would it be unusual for next year the market to go up significantly either. So, as you can see on the chart here, again, building off the election year cycle data. So, the year 3 Q1, which would be Q1 of 2023, of course, that has the strongest performance of the stock market in terms of, election year cycles. And so again, if you kind of if you tie all this together and think about it for a minute, the midterm is, always when there's the most rhetoric and campaigning, and the current administration has had an opportunity to implement, or at least try to implement, some of their policies, and the other side's always coming in saying, well, we don't think it should be that way. We're going to try and change things. So, and it doesn't matter which side it is, there's always going to be that tension like that, and the market doesn't like tension or uncertainty. And tends to sell off in the face of that. So, regardless of which side wins in any given election year, the market now kind of knows what it's dealing with. And so it tends to react positively to that, which is why you see there in the third year of the presidential cycle, Q1, which really is just the first post-midterm quarter, is when the market tends to have its best results, because all that uncertainty, or a lot of the uncertainty that was present during the midterm year, is now over, and the market can sort of feel more comfortable that they know what the at least immediate future is going to look like, regardless of which side it's on. So one of the best statistics, I think, and yet least understood statistics, is displayed on this screen here. Stocks spend more time in bull markets. And there's an old saying in the market that says that more wealth has been lost waiting for the bear market or waiting for a correction than actually has been lost in the corrections or in the bear markets. And this chart really proves that out. So if you look in the upper left-hand corner here where it says average duration of a bull market, 2,069 days. The average bear market lasts 446 days. And during that 2,000-day average bull market, the market goes up almost 210%, and the average bear market goes down by 38%. So the bear markets are obviously they're painful. They're much shorter than the bull markets, but they're very painful, so they can be difficult to kind of stay the course and stick with it. But there's ample evidence to show here that if you don't stick that out, then you're going to miss at least a portion of the bull market and probably lose a lot of wealth as a result of that. So we talked a little bit about recession and non-recession bear markets at the very beginning, right? I hinted at that. And so, again, lots of discussion as to whether we're in a recession, whether we're not in a recession, whether we're about to go into a recession. But one thing that you would notice is that non-recessionary bear markets tend to be shorter and less severe. And so, really only 3 times going back to 1950 has a bear market happened or occurred without a recession. And in each of those 3 times, it's been, pretty short, relatively short periods. You'll see 7, 15, and 19 months. And more importantly, immediately following that were very strong returns in the market. So, and in fact, if you go back to 2020, March of 2020, that was the fastest bear market ever, going from a new high to down 20% in only 16 days. And then, of course, we know what happened after that. As we said before, the market was positive by double digits by the time the end of the year rolled around. All right, so next principle is market timers miss out. The problem with trying to time the market is you got to get 2 decisions wrong. You have to be able to time it correctly on the way out, and you have to be able to time it correctly on the way back in. You may be able to get one of the 2 of those right. On occasion, maybe you can get both of them right. I've always told clients throughout the years, kind of jokingly, that the worst thing that can happen early in your investing career is you get both of those right one time. Because typically when that happens, now you think you can do that on a regular basis and repeat that. And if there were a formula for doing that consistently, I probably wouldn't be doing this webinar right now. So it's very, very difficult to do that. And again, it sounds kind of cliche, but what's more important is time in the market rather than timing the market. And some great statistics. If you take nothing else away from today's session, remember these numbers that you see here. So, again, this is looking at the implications of either being in or out of the market over the last 20 years. And if you had invested $10,000 starting back in 2001 in the market, the S&P 500, that would have grown to roughly $62,000 over that 20-year time period. If you just missed the 10 best days, so just the 10 best days in 20 years of the market, you cut your money or you cut your gains in half. So instead of having $62,000, you had about $28,000. Just the 10 best days. And in a staggering statistic here, if you missed the 30 best days, your $10,000 only grew to $10,904. So again, it'd be incredibly unrealistic or unlikely for somebody to miss only the best 30 days or only the best 10 days. I get that. But the point is to illustrate the idea here that, if you do miss some of the best days, and really probably more importantly, the implication is most of those best days happen right after some of the worst days. And so if you miss some of those days, you're really, really limiting your ability to either recover from the market or just to build wealth over time. And it's really important that you do actually stay invested when the market is down. And that's one of the main kind of points that I want to hammer home here, and hopefully you can take away from today's presentation. Okay, so let's transition now. Now that we've talked about the 8 opportunities, the 8 principles of the market. Now let's talk about, what do I do about it? Where do I go from here? And how do I take advantage of what's been happening in the market? So we're going to go through 9 specific ideas as to how you can take advantage of it. Number 1, make your IRA and retirement plan contributions. So the old adage, buy low, sell high. If you haven't made an IRA contribution or a retirement plan contribution and you're eligible to do so, why not do it when the market's down? You're simply buying things on sale. Number 2, consider Roth conversions in the midst of a market decline. And that's another, back in 08 and 09 in particular, we saw lots of clients, and even really opportunistic people in 2020, we saw lots of clients taking advantage of the market being down to convert traditional IRAs over to Roth IRAs. Just to kind of refresh on how that works. So a Roth conversion is you're taking money that's not been taxed before. So it's in an IRA or a pre-tax account, could even be a 401k, and you're paying the taxes on it now to put it into a Roth IRA. But in doing so, provided that you follow the rules with how long you keep it in there and so forth and your age, then that money's never taxed again. So why wouldn't you do that when the market is down and it costs you less in taxes to convert that money over to a Roth? Because if you think about, if you had $100,000 in an IRA right now and it went down to $70,000, and then you converted it to a Roth, and then it goes back up to $100,000, well, now that $30,000 of gain will all be tax-free. Whereas had you not done that in the first place, that same $30,000 was ultimately going to be taxed as ordinary income when you took the money out later on, right? So be opportunistic with your Roth conversions. You just want to be careful that in doing so, since you're taking on that additional income, you want to be mindful of how that affects the rest of your tax situation. Number 3, consider your cash flow. It's always good practice in retirement to make sure that you're not taking too much from your portfolio. If you had a portfolio that had $100,000 in it and you were taking 5% each year out from it, so that's $5,000 a year, just as an example, and now all of a sudden that portfolio went down to $70,000 and you're still taking that same 5% out, you're still taking that same $5,000 out, that's no longer 5% anymore. That's a higher percent of your portfolio. And so it can kind of create a downward spiral situation, and that's a good recipe for running out of money. So you want to make sure that you've got a good handle on your budget and consider your cash flow. So if you can delay certain things, delay them. If you can push them off until the market recovers, do so. Or if you've got other sources of income that you can draw on while the market's down, so as to preserve, really to prevent you from having to sell your investments when they're at a loss or when they're down, then you should look and try and do that. Number 4, if you're thinking of retiring, perhaps consider delaying that retirement until the market's stabilized. That might be bad news for some people, but the impact of retiring in the midst of a down market, depending on your situation, or retiring and then immediately thereafter, your portfolio suffers huge losses, can be devastating, can be impossible to recover from, or at least very difficult to recover from. So if it's possible to delay that retirement, sometimes it might only be 6 months, 12 months, maybe 18 months. Think about our data earlier about the average bear market. The average bear market only lasted a little over a year. So if that were the case, the odds are on your side that if you're retiring in the middle of a down market or about to, chances are before too long the tide will turn. In which case maybe your plan's back on track again. But in the meantime, if you're in the middle of it, it may be a good plan to delay your retirement a little bit so that you're not drawing from your portfolio at the very beginning in the midst of a down market. Number 5, consider investing cash that's sitting on the sidelines. Now, granted, as interest rates go up, it makes cash look a little bit more attractive. It's, at least not earning 0.0001% anymore. Maybe you're earning a little bit more than that these days. However, with inflation, are you really earning that much more? Cash, sitting on the sidelines, if you just look at where in any down market, but in particular in this year, relative to where we started the year, stocks are certainly on sale. And so, again, going back to the first point about the IRA contributions, buy low, sell high, you want to buy low and you want to sell high. So this may be a good opportunity for you to be opportunistic and buy into some stocks, whether it's the broad market, whether it's a sector that you think is unnecessarily depressed right now. But in the long term, if it's money that you think you may hold for 10, 15, 20 years, remember our slide earlier, tying it back together here, showed that the market has never been negative over a rolling 15 or 20-year time period. So this is long-term money. The odds are in your favor that that's going to beat out what cash would do over that same time period. Number 6, consider rebalancing your portfolio, selling overvalued and less desirable positions, or rotating the areas that you previously thought were previously hesitant to consider, commodities, cyclical stocks. All of that can make sense. Rebalancing in general is one of the first things you should look at doing when the market goes down. So going back to our previous slide when we were talking about volatility, in the context of a 50-50 portfolio where you've got half of the money in stocks and half in bonds. Not saying that's right for anybody or for everybody, certainly, but let's just use that as an example. And stocks go down and bonds go up, or maybe bonds go down but not as much as stocks. You're no longer going to have a 50-50 mix in that portfolio, not because you changed anything, but simply because those two things are moving at the same time, but they're moving in different directions. So if I had $100,000 in a 50-50 portfolio at the beginning of the year, and the stock market went down by 10%, and the bond market, let's just stayed even, I would no longer have a 50-50 portfolio. In fact, I'd probably have a 45% stock and 55% bond portfolio. Well, rebalancing means getting those numbers back into balance, into equilibrium. If I know that 50-50 was my target based on my time horizon, my risk tolerance, the amount of return over time that I needed to achieve to make my plan work, then when it gets out of whack, I gotta rebalance it and get it back to that 50-50 mix. And so the reason I'm bringing that up in this context is portfolios when the market's down, that's when they tend to get the most out of balance. And that's also when investors tend to ignore them the most, by the way, and not rebalance because, either out of fear or inaction or anxiety about what to do or how to react to the market going down. And by the way, that's where professional help can come into place. Having a third party that's objective and that's not emotionally invested and involved in your portfolio, that can look at the situation and assess it from an objective third party standpoint, can be very helpful, because it helps you to make the decisions that you should make that maybe you're reluctant to make because of emotion or lack of knowledge, maybe even. Number 7, with so many broad-based losses, consider tax loss trading. So I've been harping on buy low, sell high here, and this is the one exception to that rule. So the one exception to that rule is of buy low, sell high. Sometimes it makes sense to sell low. And when it makes sense to sell low is when it works in your favor from a tax perspective. So in a year where the market's down, usually opportunities to harvest tax losses are abundant. And that's no exception right now. So what tax loss harvesting looks like is if I've got an investment that is down. Let's say I bought it for $50,000 and it's down by $10,000. It's down to $40,000. If I sell that investment, I can take that $10,000 loss and I can apply $3,000 of that to my income this year, but I can apply all of it to capital gains either this year or any year in the future. And so, for example, let's say I had a gain in another stock or another fund, or let's say I've got a stock that I inherited 50 years ago from my grandmother or my grandfather, and I see this all the time, that I maybe have kind of been thinking about selling over time, but have been reluctant to because of the taxes. I didn't want to pay the capital gains taxes. Well, this is a good opportunity. If you've got something else in your portfolio that's at a loss, you could sell that, take that $10,000 loss, and then sell all or a portion of the stock that you inherited from grandma or grandpa, and perhaps be able to get out without any capital gains taxes on that particular stock. But even if you didn't have the stock from grandma and grandpa and you sold the stock at a $10,000 loss, in my example before, you apply that first to any gains you have this year. Then again, the $3,000 would be applied if there's any left over to your income for this year. And then that $3,000 can carry over for future years to be applied towards income, but all of it can be carried forward into the future to apply towards capital gains. So one thing you want to be cautious of there is wash sale rules. Make sure that you don't buy back the same investment or something, as the IRS calls it, substantially similar within 31 days of selling the initial investment. That's a very, when I mentioned before making lemonade out of the lemons, that's one of the best ways to make lemonade out of the lemons that the market gives you when it's down. And again, that's something that we can help you with here at Certified Financial Group. So I would encourage you that if you've got questions about that particular strategy or how to implement that in your situation, please reach out to us and set up a time to discuss. Number 8, consider getting more aggressive with your asset allocation strategy. If you have a long-term time horizon and the proper temperament. So, this kind of goes along with the buy low, sell high strategy that we violated in the last rule, of course, but now we're putting it back in play. It just says that, hey, if the market goes down and I'm a long-term investor, what better time to really load up on stocks than when it's down from where it was before. And if you look at historical charts, go back and look at the end of 2008, 2009, and had you really loaded up, and of course this is hindsight now, but had you really loaded up on stocks then, that would have really paid off now, almost 15 years later. You don't want to necessarily do that with money that you're going to use in the short term. Okay, so this is more for money, that is earmarked for long-term savings. This could be for, if you're a younger person in your 20s, 30s, or 40s, this could be retirement money for sure. But if you're closer to retirement or in retirement, maybe this is money that's earmarked for a legacy for your kids, grandkids, etc. To be able to be a little more opportunistic. And if the objective with your normal retirement money is 60% stock and 40% fixed income and bonds, maybe you say, well, if the market goes down with this money I've got set aside for the kids or the grandkids, I'm going to be a little more aggressive. Maybe I'll be 80 or 90% in stocks with that money because I know that if it fluctuates from month to month, year to year, it's not going to jeopardize my ability to pay bills, but it will be more appropriate for my kids and grandkids because they have a longer time horizon. Okay, and then finally, review gifting strategies in a down market. So, and this is a whole other topic of conversation. Suffice it to say, there are a number of estate planning techniques that can be implemented if your situation merits that when the market is down. Much like the Roth IRA, where you're kind of locking in the value today from a tax perspective so that all the future growth is tax-free. There's a number of estate planning techniques that in essence do the same thing, and can really save your estate and your heirs and beneficiaries a lot of money down the road, particularly if you have an estate tax problem, and particularly if they change the estate tax limits. But that I'm not going to go in depth on that because everybody's situation is a little bit different. If you do have an estate tax problem, or if you're more interested in how exactly to make use of some of those strategies from an estate planning standpoint, opportunistically in the middle of a down market, certainly feel free to reach out to us, set up a time to discuss that, and we can kind of walk you through how that works. So I hope you've gotten some good information out of this particular presentation. Again, first part was to kind of give you some background and education, compare what's happened in the history of the market to what's going on today. And then the second part is to how to put that into practice specifically. And that's really what it boils down to. You can gather all the education that you can read, you can listen to, and watch webinars like this, but until you put that information into practice, it's all academic and it's all on paper. So my call to action is reach out to us, schedule an appointment with myself or one of the other planners here at Certified Financial Group, and let's talk about how we can get a plan in place for you and make sure that we're implementing some of these strategies opportunistically while we're still in the midst of a down market like this, before the opportunity wastes away. So thank you very much for tuning in today, and I look forward to seeing you next time.